Lobo Tiggre of the Independent Speculator is back. We're going to be discussing first and foremost his $150 silver call and $3,000 gold outlook. Of course, he's not calling for this to happen tomorrow, but we'll be talking about this thesis and, of course, inflation, Basel III, what happened, what didn't happen, and importantly, sentiment in the gold space right now. Lobo, welcome back. A lot to discuss today. I'm happy you're here.
Yes, I'm glad to have a chance to follow up on some of this important stuff.
Let's talk about sentiment first and foremost. So you and I spoke not too long ago, and towards the end of the interview, I promised the viewers we follow up on this, but you kind of just snuck this in there before we took off. $3,000 gold and $150 silver. I said we follow up on the next time, and here we are. So what's your thesis there? Why are we headed for much higher prices down the line?
The thesis is fundamental more than chartist. The thesis is, as I'm sure most of the audience is on board with, the monetary and fiscal policy. And the specific numbers just come from looking at previous peaks. And if you adjust those for inflation, that's what takes silver actually above 170 and gold above 2,700. And I just can't see it stopping there. I think it would keep going for a while. So this is not a prediction in the sense of, by X date it will reach this price. This is my expectation. I think at the very least, before this particular bull run is done, we will see those prices in gold and silver. For our gold and silver bug friends out there, could it go much higher? Yes, absolutely. If the US really goes off the rails and the dollar implodes, sure, it could go much higher, many thousands higher for gold. But who knows if that's going to happen? I'm not going to go out there and make that call. I'll just say that card is in the deck. So, but for right now, I think it's game on for that. The big question, David, you didn't ask this. You're very polite, but it's gone into retreat. What's wrong? Why hasn't it gotten there yet?
I was getting there, but yeah, please let us know, Lobo.
So. And this ties into the sentiment question. The answer is nothing's wrong. If you pull back to
Sorry, before we get into the sentiment, I have one follow-up question on what you just said about the bull market. You said before the end of the bull market, we could reach those prices, $3,000 gold, $150 silver. How long is this bull market going to last, Lobo? If you take a look at the last bull market up till 2011's peak, that took about 10 years. We're currently 2 years into our bull cycle if you count the start as being 2019. So
yeah, I wouldn't do that. I'd actually count from the bottom in late 2015.
Okay.
Which gives us another 4 years. But history never repeats exactly, right? It only rhymes.
Sure.
So yeah, but that's not an unreasonable expectation. And honestly, if you look at the real world, never mind the charts, what's going on in the real world? 4 years from now, can the powers that be really kick the can down the road that long? It would seem like with the charts just going through the roofs on the national debt, the Fed's balance sheet, U.S. to GDP debt ratio, things like that. It seems like something's got to give before then. So I don't think that's an unreasonable time frame, David.
So lightning doesn't.
Sorry, real quick. One other thing though is if you look at the crash of 2008 as a starting point, and then on up to the peak in 2011, the proximal cause of that fear injection in the markets in 2008. Well, that's 3 years. So if you look at last year, March of 2020 is the crash this time around. Well, we're just, barely over a year after that. So there's plenty of room to look for those higher prices that I expect.
I was going to say, look, lightning doesn't strike the same place twice. So could be faster, could be sooner. $3,000 gold, really, it's a big number, but it's not a huge increase from where we are right now. If you round, let's say we round up to $2,000, it's only about a 50% increase, which
exactly.
We've seen more than that in the past decade. However, $150 silver, I'm not so sure about. We're what, $30? Not even. That's 5 times.
Right.
That's a bigger gap.
Which is why we talk about these prices a lot, David, and people get upset because I'm not bullish enough. Or they get upset because I'm not realistically bearish enough. I'm giving you my outlook. I'm not making a prediction. And by the way, I'm telling you how I'm investing according to that outlook. That's where the money hits the road, is I'm putting my money where my mouth is. I might be right. I might be wrong. But this is what I'm doing. And you're asking what I'm doing. So that's it. But silver, though, that's why I've been particularly looking for great silver stocks. And unfortunately, there are so few primary silver stories. And sorry, all my silverbug friends out there, so many of the ones that are out there have warts. There are serious due diligence questions that we should be asking ourselves about these silver stories. And just because it has silver in the name, or even some silver in the drill results, doesn't make it a great speculation. But that, that's the mining business. Separate question in a way.
We're going to get to that
your
later,
point.
yeah.
But yes, it's precisely because silver really has gone that high, right? It's gone plus or minus $50 twice before. And if you adjust those numbers for inflation today, that's how we get to that number, David. Will it go that high? I don't know. Could it go that high? In real terms, it has twice before. So yes, I think it could.
Well, you are the due diligence guy, Lobo. I'm not just making that up. That's your Twitter handle, actually, at due diligence guy. Let's talk about your due diligence on sentiment. Let's go back to sentiment. You wrote this, some would say Debbie Downer article on your website. I thought it quite enlightening. You made some realistic points. Yes, you're right. In your article, you stated that sentiment right now is very weak. People are frustrated. I'm just going to read the first couple quotes you had at the top. Silver's getting crushed today. I'm so sick of this. Gold's up, but gold stocks are down. Something's wrong. Silver should be $150 an ounce. $28 is an insult. Are these real quotes you've heard from your real life, or are these just examples?
They are a little bit of both. Like I didn't actually go back and pull a quote from someone because I'd have to ask for permission.
Yeah.
But they are all things that I've heard. And the insult, that word came from somebody out there in the Twitterverse or the YouTube verse out there. I didn't make that word up. But let's focus on that because that's, I think, really important. I mean, markets are buyers and sellers coming together, and a price is whatever clears the market. And if you are, as most gold and silver investors and stock speculators are, most of us are hard money advocates. Most of us believe in free markets, free enterprise, the free price system. Now, I understand that there's concerns about manipulation in the space, but the point is that a price is whatever buyers and sellers agree on. It actually makes no sense intellectually, philosophically, or from our overall worldview perspective as advocates of free markets to say what the price should be. It is whatever buyers and sellers agree. Now, is the market distorted? Sure. But the price is what it is. Yeah. And if you're going to be insulted by a price, think about insulted. You're going to be insulted by a price. Well, that tells me that people who feel that way, they're being very emotional. And that's very dangerous. That was really the point of the article that you mentioned, which is available for free on the website. It's called Don't Hold Your Breath, or Investors Never Hold Your Breath. Lessons from scuba diving, where holding your breath is very dangerous. And I think that applies to investors. I think it's just look at the successful people out there. Look at your Rick Rules of the world, or even Doug Casey. They're very different personalities.
Yeah.
But both of them are very relaxed, very calm. They roll with the punches. They don't get upset. They don't get insulted. When have you ever heard a billionaire say, "Oh, I'm insulted by this price"? They're not emotional about these things. They say, "Oh, well, that didn't work out," or they say, "Oh, well, that's an opportunity."
Yeah, I think the frustration comes from the fact that, well, there's a lot of things. We'll get into inflation a bit, and we covered inflation last time. But suppose inflation does run hotter than expected. Suppose that we make the assumption that gold and silver are inflation hedges to some various degrees. Then it should hold logically that these metals should run should go a lot higher given where inflation.
But we talked about that last time too, David. And I hope the audience will remember if they like following our conversations, David. The audience will remember we talked about that. When everybody can see that coming, it leads. Right. So the fact that gold is up, in response and ahead of all these incredible things in monetary and fiscal policy that the powers that be have done. Right. Gold hit 2,000 last year. That was a leading indicator for the inflation that we're seeing now.
Yeah.
So there's nothing wrong with that. That's people rationally saying, "Oh, look what's coming. The bleep is coming down the pike and about to hit the fan. So this is a good hedge. Let's move in this direction." And they did. That's how these things work.
I think the other frustration is that it's difficult to price gold and silver at their fundamental fair value. If you take a stock, for example, there's various valuation techniques you can apply, but it's very easy to see when a stock is overvalued. Suppose it's trading at, 400 times price to earnings and is making no earnings at all, or something. PE in that case is going to be infinity because there's no earnings. It's very easy to see when something's just hyped up for a stock, or not easy, but relatively simpler. You can't tell that to the people in 2001 that it was easy. But my point is, what's the benchmark for valuing gold and silver? There are very few that I can think of. So one could argue gold should be at $2,000. One could argue it should be at $1,500. One could argue it's at $3,000. Who's right?
Well, going back to what I just said, there is no should. I think it's wrong to ask that question. What's useful? Well, two things. One is I own gold and silver bullion. I've got a stack of my Canadian wolves right here. Haven't had a chance for midnight gardening yet to put that away properly. But I don't own those because I think the price of silver is going up to 150 or whatever. I own it because it's silver. And come heck or high water, that's a conversation you and I have had. My real life story about how my childhood silver coin collection fed my family in time of dire need. And I have more savings in gold now than silver. But that's what it's for. I'm not worried about the price. My reason for stacking has nothing to do with where gold or silver prices should be or are going. As a speculator, I do speculate on the stocks. And for that, whether gold and silver will go higher does matter. If they've peaked last year and it's all downhill here, and I'm being a mindless cheerleader, oh, they're going higher, that's bad. That would point people in the wrong direction. So I'm trying very hard not to do that.
Yeah.
And sorry, just to wrap that up. So for what it's worth, I think all the reasons for gold and silver to go higher are fully in force. I think that a lot of it was priced in advance. I think the crisis in 2020 pulled forward a lot of that into 2020. So it is natural for there to be a period of correction and consolidation now. I don't see anything wrong with these markets at all. And if people are frustrated, I promise I'll give you a chance to talk, David. My advice to them is to go to the Kitco website, go to the gold price chart, that nice black chart with those dramatic, bright colored lines. But don't look at that. Look at the little box next to it. There's a little table there that shows you the price of gold change over the last 30 days, 6 months, year, 10 years, and since 2000. And all the numbers in the red are short term. So if you're feeling pain and you're feeling worried because gold isn't doing what it's supposed to do, look at the long-term numbers and understand that the problem, or the red, is short-term, and the opportunity that means given the long-term scenario. That's the bottom line, David, is I think this negative sentiment, this bearishness that's pervaded our space is a fantastic opportunity. And I am putting my money into that now. I've been bidding for stocks this week. I've been... my stink bins have been too stinky. I haven't gotten filled yet, but I am putting my money where my mouth is, and what I'm saying to you right now, David.
The negative sentiment, yeah, you're right. I mean, one could interpret that as a bullish statement because sentiment, from what I've learned, is usually backwards looking, or it's a coincident indicator with prices. Yes. People don't think, well, things are going to get a lot better, so therefore I'm going to feel good. No, it's like prices have been flat, therefore I feel bad about it. And so one could argue that this negative sentiment is a bullish indicator because prices have consolidated long enough.
One could, and as a contrarian, one would. The problem is it doesn't tell you when it's going to turn. It doesn't tell you that it's not going to get worse before it gets better.
Sure.
But this comes back to something you said, right? I'm not here to speculate on gold and silver. I'm here to speculate on stocks, and you can evaluate the stocks. And the way I look at things like this, it's like a time machine. Like if there are great companies that got away from us before, we were skeptical, or we just didn't notice it, didn't come up on our radar, and now it's way overpriced. But then this bearish sentiment gets in. There's a market correction, or in this case, it's not even that much of a correction in the metals. It's more of a correction in the mining stocks and in people's psychology. Well, that's fantastic. If it gives us a chance to buy a stock that has now delivered great value, they've added, metal in the ground through drill results, or they built a mine, or whatever it is, they've added value. And now the stock's on sale for the same price before it added that value, maybe even cheaper in some cases. That's fantastic. It's like having a time machine and being able to go back and buy the winners before anybody knew they were going to be winners.
Yeah, I'm looking at the GDX index, for example. Let's talk about mining now. I'm looking at the GDX VanEck Vectors Gold Miners ETF. It's a basket of the large cap miners. It's at 34.47 per share. last year, exactly a year ago, I'm looking at the 12-month chart, it was above 45. So that's, $10 difference. That's about 25% drop in 1 year. I mean, it's not great. Could be worse, but
Right, but that's the larger companies. You look at some of the
right,
smaller ones.
probably
And
even more. Right?
I'm not an ETF kind of guy, David. I'm not an index guy. I want to make my own stock picks, and I hope that I can do better than the average bear or wolf or bull, as the case may be. But it's more. I think it's more telling to look for the value isn't in buying the index just because it's down. I mean, it can be, and for a cautious investor who just wants some leverage without going way out on a limb, or who doesn't have time to do their own due diligence, or hire me to do it for them, maybe that's a good way to go. But what I want to look for is a stock that is now unrealistically, unreasonably beaten up. Like some big shareholder just decided to get out because they were sick of it. They were insulted by the current gold price, so they got out. That can be a fantastic opportunity. And what can I say without giving you stock tips? I don't like doing that, David. Let me give you a practical sort of guideline here.
Sure.
When gold's making records and silver is going nuts and these prices go crazy through the roof, you get to really beyond ludicrous mode in your Tesla there. You get to just unbelievably ridiculous valuations. As you mentioned, you have something that would be an outrageous PE if there was any E at all. Like there's no E. Or you get discoveries in which there's no resource, pre-production. You have no resource. You have, some guesses as to how much gold or silver or whatever might be in the ground. But there's nothing real to hang a value on. And without doing the metallurgical studies to know how much of that gold could be recoverable, even if it's obviously big, it's not necessarily obvious that you'll make money mining that. Mining is a difficult business. So you get these beyond ludicrous, just unbelievably beyond any sense of proportion valuations. And if that corrects 50%, well, you know what? You're still in ludicrous mode. This is the practical guidance I'm trying to pass on. Is I've made mistakes in my past picking stocks that had been market darlings, had gone through the roof, and now, oh wow, it's off 50%, or we can get it for 60% less than before. And I thought that was a great opportunity. But if the value was actually 0 or 10%, then a 50% sale is actually not really an opportunity. So you don't want to buy indexes. You don't want to just buy anything because it's down. You want to look at some credible value proposition. And either they have a 43101 resource or a JORC resource in the ground that you could put some kind of number on, or there's book value in the case of a producer. And to say, look, the value of the enterprise is off 10% given the price of silver or whatever, or gold. But the share price or the market valuation, the EV in particular, is down 25% or 50%. That's an opportunity. If you have something that's pie in the sky, this is going to be the biggest thing ever, but there's no actual number for what it's worth, and that's down 50%, it may never come back. Those things don't always work out.
Okay. Excellent. We'll follow up more on your mining insights because you are the expert on junior mining picks. So we'll follow up more next time. We got a couple minutes left, Lobo. Let's follow up on two things you've said last time or in prior conversations. I can't even remember which it was last time or the time before. But we talked about your inflation call and Basel III. Let's start with Basel III. It's and we'll move on to the inflation. You mentioned that it wouldn't have any significant impact on the price, and sure enough, the transition happened this week. Nothing happened. Why were you contrarian when the rest of the gold buck community was calling for prices to go to the moon?
Let's not be too harsh here. I didn't say it doesn't matter. But there was all this hype about, Basel III, and it's great, it's going to send gold through the roof. There's other people saying, no, it's terrible. It's the central bankers are doing this, so it must be bad. Gold's going to crater after this. There's a lot of hype about that. And I called for caution. I said, don't expect things to go vertical one way or the other overnight the next day. And I'm sure glad that was my expectation, because it's been bad. Basically nothing's happened.
Well, yeah,
but that doesn't mean it's important. Just to quickly put a period to this, my thing is, don't get caught up in the hype. People get mad at me because I'm not hyping the next big thing that tells them what they want to hear. But I'd much rather be right than tell you what you want to hear.
I understand.
So that's how I see this Basel thing. Remember, the LBMA and the World Gold Council did ask the powers that be for an exemption for the futures trading markets on this. So it does matter. I'm not saying it doesn't matter. I'm just saying that I don't think it was realistic to expect anything to blow up or go sky high overnight. I understand that the full implementation of that rule isn't until next year, and I've seen screenshots for different things, different claims. So I think it's interesting. I would love to see it push the paper market towards a more greater connection to physical price discovery, and I hope that will happen. But I just don't expect it to happen overnight.
Well, speaking of hype, Lobo, higher inflation is all the hype this summer. And we spoke about this last time. You called it summer fireworks to be expected. We're entering July now. We're officially summer. So let's talk about it. 5% CPI, can this hold? Can this sustain, or will it be transitory?
Right. So here's one where maybe I need to do a little bit of preemptive mea culpa here. I don't like to make big predictions, but we talked about, if we're going to talk about fireworks, of course, people think about 4th of July. As you and I speak, it's July 1st. I only have 3 days left to see those fireworks on the 4th of July. Though I have to say, I didn't actually promise they would be on the 4th of July. The point was that by now, the base effects from last year's very low dips in CPI and the Fed's favorite PCE numbers would be rolling off. And so this dismissal of everything inflation as being, transitory. Well, if that was true, if the transitory yarn was real, then we should see those numbers curving down. We should see the base effects actually turn negative for inflation by now. And that hasn't happened yet. And if you remember what I said in our talk, I said it would send tremors through the powers that be, that their transitory expectations were not being met. I didn't actually promise that the price of gold would, go to 3,000.
No, you didn't. Yeah.
So I actually think that's happening now. I think you look at the PCE in particular, the Fed's supposedly favorite measure of inflation, and the low last year, the peak base effect was in April. And in May, it had really recovered like 80% and then on upwards from there. So the base effect from last year should have been much higher last month, or rather mathematically it was. And therefore, if it was all about the base effect, the May PCE number should have been much less, but it wasn't. It was higher. So that says that you can't just dismiss it as all a mathematical artifact from last year's low numbers. There's real inflation now. There's higher prices now, and they haven't just gone away. And even Fed officials, two of them that I've tracked so far, have said, well, maybe transitory is going to be a little bit longer than we thought.
Sure. Well, so final question then. What are the powers going to do? Well, what will they do about it?
Well, the first thing, I'm not a central banker. I can't tell you what they are going to do. But what I would say is I think it's a big mistake for people to assume that this means they're going to raise rates sooner. Mm-hmm. This situation tells me that, well, if they change their policy, and they have telegraphed this too, the first thing they do is they taper the bond buying, the $120 billion a month in asset purchases are making. I think that happens first. So before anybody needs to worry about the Fed raising rates, I think you look for that to happen, that kind of tightening. And why does it matter if they raise rates? Well, because gold doesn't pay interest, and real rates have been, as we know, such a powerful determinant in gold prices over the last 50 years. Which brings us to the actual point that you and I discussed last time and why this came up, is that this year gold has been tracking the dollar more than rates. Yeah. And that's really interesting. In this context, I think it tells gold and silver investors that there's the data is telling us we don't need to worry as much as we might have in the past about this business of higher rates being necessarily instantly bad for gold and silver. The dollar, I think, is on our side in that I'm a dollar bear, and I suspect most of the audience is as well. And I think traders out there are starting to discount the day-to-day changes in the nominal rate because the real rate with these high inflation numbers is what matters. And all of this is very bullish to me. So
absolutely. We'll follow up more on the dollar.
I'm putting my money where my mouth is on this, David.
Okay, excellent. Well, that's what we like to hear. That's what we like to hear. Someone who's long-term bullish. Well, I guess some people like to hear that. I don't know if you want to buy in the dip. I guess you want to be bearish. But anyway, thank you for your thoughts, Lobo. We'll follow up more on the dollar and Fed policy next time. Thank you.
Thank you, David. And audience, keep your chin up. I'm with you there.
Don't be insulted.
Don't be insulted.
By the price. Right. Thank you for watching Kitco News. I'm David Lin.